Imagine a company that promises to grow bigger, yet pledges not to leave current shareholders behind. MREI began 2026 with this familiar challenge, and over the first half of the year, it delivered results that seemed impressive on the surface. Revenue surged by 26.3%, reaching 3.41 billion pesos. Net income jumped even higher, rising 31.1% to 2.53 billion pesos. These gains followed a major move, the addition of 9 office buildings in McKinley Hill. In exchange, nearly 1 billion new shares were issued. The company's outstanding share count increased by over 26%, and yet revenue grew at almost the same pace. This careful balance allowed MREI to avoid diluting earnings, with basic earnings per share inching up by close to 4%. For investors, that's a narrow but important victory. The expansion did not erode the value of their shares. Instead, better margins delivered a modest boost. Most income came from recurring sources: rent, dues, and property operations. There were no one-time gains from revalued properties. Distributable income, the figure tied to future dividends, grew 33.7% to 2.49 billion pesos. Dividends per share also edged higher. Yet beneath the headline growth, a critical issue surfaced. Operating cash flow fell to 1.50 billion pesos, down nearly 15% from last year, even as reported profits soared. Cash flow now covered just 59% of net income compared to 91% a year ago. The culprit? A sharp rise in receivables. Outstanding bills and advances ballooned by 1.67 billion pesos in 6 months. Management pointed to higher billing and collection timing, and the new properties certainly played a role. But almost 36% of trade receivables were past due, with a significant portion outstanding for more than 4 months. The company confirmed these balances remain collectible, supported by deposits and advance payments. Still, they hadn't been converted to cash. This matters because in the first half, dividends paid to shareholders outpaced cash generated from operations. Cash balances shrank dramatically, raising questions about sustainability. MREIT is conservatively financed, debt levels are low compared to equity, and no immediate balance sheet crisis is unfolding. But real estate investment trusts rely on cash, not just accounting profits, to sustain dividends. If receivables normalize, the cash flow issue may prove short-lived. If not, reported earnings could outstrip available cash. A risk investors must watch closely. Ultimately, MREI's expansion avoided share dilution, and margins improved. Yet the company has not fully demonstrated that earnings translate into cash, leaving investors both hopeful and cautious as they await the next financial disclosure. In prudent investing, real growth means real cash.